This morning's April employment report was a disappointment, to say the least, with payrolls rising just 266,000, well short of expectations for a near 1 million gain. On the heels of a 770,000 rise in March, revised down from 916,000, the April report was expected to continue the theme of solid momentum in job creation as states continue to roll back restrictions and capacity restraints and welcome consumers back into the market, boosting expectations then for the broader recovery, as well as an expedited timeline for eliminating the deficit of jobs destroyed since the onset of the pandemic. Instead, this morning's slower than expected pace of hiring, coupled with an uptick in the unemployment rate, will serve to undermine confidence in the strength or robustness of the recovery and potentially strengthen the call for further artificial policy support amid an uneven economic picture. From the Fed's perspective, this morning's shortcoming will reinforce policymakers' push for patience and support for ongoing accommodation. Recall at the latest April FOMC meeting, the Fed opted to maintain its current policy position, with rates unchanged at near zero levels and the pace of asset purchases steady at $120 billion a month. In the statement itself, the Fed acknowledged the recent improvements in the domestic economy as well as the backup in prices. At the same time, the committee emphasized the still incomplete nature of the recovery. In fact, during the press conference, Fed Chairman Jerome Powell championed the gains in the labor market, at the time creating or replacing more than 14 million jobs since the onset of the crisis. He also noted, however, there remains substantial slack in the labor market, with some industries or particular segments of workers disproportionately harmed as a result of the pandemic and related policies. With nearly 1 million jobs added in March, Powell said, he would like to see a string of solid months like that. One good or even stellar jobs report, he clarified, does not indicate a lasting trend or support an adjustment in policy, and perhaps he was right. Of course, this morning's downside surprise in hiring, with the unemployment rate pushing back above 6%, comes against the backdrop of a slew of solid economic reports showing progress in housing, manufacturing, services, and consumer spending, which, independent of today's miss, was not enough to meet the Fed's threshold of substantial further progress needed to warrant a taper, let alone liftoff. In other words, the Fed was already cautious about the strength of the recovery. This morning's miss simply reinforces that unease. As far as substantial further progress, what does that look like? Well, despite numerous attempts and repeated pressing during last month's press conference, Powell offered little clarity as to what would be considered substantial. Because assessing that benchmark will be somewhat subjective, he told reporters, we've said we'd let the public know when it's time to have that conversation. Of course, to be fair, while offering little certainty on what is needed to generate support for a higher level of rates, Powell has been very clear that the committee will offer ample notification to the market before any rollback of policy is initiated, and that tapering itself would happen well in advance of a rate increase. Thus, putting these pieces together, the Fed continues to imply a somewhat extended timeline for the first rate increase, despite some fears of inflation, at least longer term. Corresponding to the latest dot plot, the Fed continues to anticipate near zero interest rate policy potentially until 2023 or beyond. In other words, at this point, not only are policymakers not raising rates, they're not even talking about raising rates.